And now, Lifestyles Unlimited presents the Real Estate Investor Radio Show. Over the next hour, we unfold your map to financial freedom. You'll learn how to retire through investing in single-family and multifamily real estate. You'll learn how to create cash flow and build wealth so you can have the time and money to live the lifestyle you want.
Hello and welcome to the show. This is Andy Webb with Lifestyles Unlimited. And as always, we're working on your financial freedom. You know who's not working on your financial freedom? I dare say your boss. We're going to talk about giving yourself a raise any time of the year, anytime you want to pull the trigger and do it. And it can be a pretty substantial raise at that. What does your boss do for you? Well, you know, I've done shows on this in the past. I've done a lot of reading into this, and I experienced this personally. I'm now retired a handful of years ago, thanks to my real estate. So I don't experience this any longer on the real estate side. However, I do give myself raises regularly, and you can too. But if I think back to either my research or what I experienced when I was in the corporate world, and you may have experienced this as well, the raise on average, where does that land? It's typically between 2 and 4, 5%. 3.5 is actually the average, 3 to 3.5. So do you think we can beat that through real estate investing? You bet we can. And we can do it anytime. You know, at least in my case, when I was in the corporate world, this, I don't even think it was a merit increase. It was just kind of a standard thing. They would do a performance review of the prior year. So that was usually sometime in February, March. And it was interesting because I always had to give my own self-assessment first. And then the boss would come along and pencil something in addition on top of that. And then there came the 3%. That was it. And they have a budget. And the pie is very much fixed. And if that lady over there on the team got 5% for some reason, my percentage went down. I have zero control over that. Yeah, I can do a better job, work harder, work longer, put in more hours, right? Smile, real big, beg, perhaps. But it's a fixed pie, and I really don't have the control. And what we're going to talk about today is how you can seize control. And like I said, you can give yourself a raise any time of the year, and it can be pretty darn substantial. So we're going to get into that. And the trigger for me today, what got me really thinking about this actually, is some news that came out. And this doesn't just relate to merit increases or raises or that sort of thing. But there was, I guess it's some good news. This was in the Associated Press, and this is referencing specifically an annual report that the Census Bureau publishes on median household income. And it's interesting because finally, after being in a bit of a depression there, we've finally seen an increase in the median household income, adjusted for inflation, right? We know we've had that over the past handful of years. It actually increased 4% from 2022 to 2023. That takes us from about 77K to a little north of 80,610. That is the median household income across the U.S. Obviously, that's going to vary depending on where you sit, what you do, etc. And just to remind you, the median is the middle point. So 50% of the people are making more than that number, and 50% are making less. But it's finally gone back up, and it's the first increase that we've seen in that number since 2019. And it's essentially unchanged. In 2019, the median number was a little north of 81K. So we're finally back to that, what they're calling pre-COVID peak. Now, the interesting thing, and I want to call out, this is how the article opens. It says the inflation-adjusted median income of U.S. households rebounded last year to roughly its 2019 level, overcoming the biggest price spike in 4 decades to restore most Americans' purchasing power. Now, how do you feel right now? And I talked on last week's show when we got back from RV trip out to Mississippi. We had to go to the store to stock up the pantry. I felt that. The prices have not gone down. So if you're on a fixed dollar income, has your purchasing power kept up with that? I think most people would disagree with that statement right there. Yes, the way they measure it, the statisticians, sure, they're happy, I suppose. But are you? I think you can do better. Wouldn't you like to do better? instead of sitting around and waiting. Here's what that looks like. And there's several components here, so bear with me. We're going to go through each and every one of these. But I'm going to start with the biggest. The biggest component, the biggest way that you can help yourself is by creating cash flow. Creating what we call passive income. And we do that at Lifestyles Unlimited by investing in residential rental real estate, just two asset classes, single-family rental houses and multifamily apartments. Just those two asset classes. That's all that we focus on. We don't get distracted by RV parks or assisted living, right? Elder care, that's a big one you'll hear about out there. We don't get distracted by storage facilities. We focus on residential because if you go back to things like Maslow's hierarchy of needs, everybody needs a roof over their head. This is something very basic. Don't need that RV park. Can sell that RV if I have to. Don't need to store all this stuff. Have a whatever, garage sale, get rid of it. We have to have somewhere to live. So that's why we focus on this. And when we go out and buy a single-family rent house, we're able to create cash flow. And we go and invest in apartments, we're able to create cash flow. And this is at its basic, the simplest way to go out and give yourself a raise. So we're not stuck waiting for that benevolent boss, waiting for the right budget from the company so that manager can afford to give me that 3.5%. So we'll probably stick with the number 4% since that's what we saw in terms of increase from year to year in the median household income. What is cash flow, by the way? Well, we define it as passive income here, but at its basic, what am I doing? I have a rental property. I'm going to rent that house. I'm going to lease that house or those apartments to people, to good residents. They're going to pay their rent regularly, right? Because we've done our due diligence, done our screening, things we talk about, by the way, at Lifestyles Unlimited. But we're going to rent it out. We're going to collect that rent. We're going to pay our fixed expenses. And that net that I keep every month, that is my cash flow. So can we beat that 4% that we saw from 22 to 23? By the way, median household income went up from $77,450 to $80,610. And just to put that in absolute dollar terms, that's a $3,160 increase. That's the 4%. I'll probably just call that $3,200 going forward. That's going to be my benchmark. I need to beat that. That is what I want to beat. So can I do that with houses? Okay. I've got a couple of examples. These are just a couple. I pulled these out of my email. And I get emails from the Lifestyles Realty team. And these are realty companies that are under the Lifestyles Unlimited umbrella, and they're present in markets like Houston, Dallas-Fort Worth, where I sit, Central Texas, up in Kansas City, Missouri, and Kansas City, Kansas, over in Phoenix, Arizona, over in North Carolina, South Carolina, Georgia, Tennessee. So if you are in a market, interested in your local market, and you're in East Tennessee, yeah, we can help you there. Now, I look everywhere where we have Lifestyles Realty. These couple that I grabbed, one is in Houston, one looks like it's this is a suburb a little north of Houston. But I want to look at the cash flow with you. One of these, the one that's outside of Houston, estimated cash flow. When I get this thing rented, collect that gross rent, pay my expenses, I'm going to be bringing in a net, this is profit, every month, $304. So let's just multiply by 12. Let's annualize that, $3,650. Does that beat that benchmark, that 3,200? Yeah, one house does. So I can easily go out and buy this one rental property and give myself that raise. Can I beat that? Yeah, I can. This other example I happened to grab, these were just back to back in my email. Cash flow, $454 per month. Again, that's the net. That's the net. Gross rents might be $2,000, might be $1,800. Pay the fixed expenses, keep $454 every month. Annualize that, what are we at? $5,448. That very much beats that national median increase. What if I bought both of those? Can you buy two houses? Yeah, you can buy multiple rental houses. There's no reason to stop with one, and most people don't. Typically, we build multiple streams of income. Like I said a moment ago, Dell, every year he's adding to his cash flow, adding to his income. How does he do that? He's adding more cash flow by way of these rental properties. Same for me and my wife. Every year we've bought houses or we've invested passively in apartments. So if I bought both of these houses, bam, what's $3,600 plus $5,400? We're bringing in $10,000 a year. That's a substantial raise, I would say. Do you have to stop with 2? No, you could buy 4 and double that. You could buy more. In fact, when I think back to my life in the corporate world, I was in, last job I held was in business travel. And I'm not talking about COVID. Boy, that was a rough patch. But even before that, in 2014, there was something happened in the industry. It's been too long now. I don't remember what the driver was. I think it was oil prices, but the company wasn't performing to expectations. I was performing well above expectations, always do. But they couldn't give us a raise that year. The industry didn't support it. So I got a goose egg from my boss, from the company. What did I do that year? I bought 5 rental houses. And I added $25,000 in net income to my bottom line. So yeah, you don't stop with 1. You can do as many as you can afford to do, have the time to do, etc., desire to do, the goals. But I beat the pants off of that 4% or $3,200 per year increase just by buying a few single-family rental houses. And those are houses. What about apartments? Because we do both. We invest in houses, we invest in apartments. Apartments are a little bit different, can be a little bit different. How often do you get cash flow from your houses? Monthly. That is a monthly thing, every month. Apartments, typically, those are paid in distributions from a syndicator. We call those leads on a quarterly basis. So you'll see maybe a bigger pop in your bank account. But we do see cash flow on both houses and apartments. And I'm happy to report, I look back at 2022 and I look back at 2023 and my cash flow just from my apartments doubled. What did I do? I added a few syndications, a few investments to my portfolio, but that's it. I don't do anything on those. It's purely passive. Sit back and wait. So every year you can add more and more income to your bottom line. You choose when it happens. I chose to buy 5 houses in 2014 and add to that bottom line. You can do the same. When we come back, we're going to get in a little more detail into a couple other plays you might experience as well.
Lifestyles Unlimited's Real Estate Investor Radio Show returns in a moment. Got questions? Go to lifestylesunlimited.com.
Lifestyles Unlimited member Lisa appreciates having mentors who have her back.
Having the faith to move forward, and y'all have everything provided. I could call a mentor and say, hey, I don't know what to do. Someone is always there to guide you. I have backup.
Lifestyles Unlimited. Over 33 years teaching the real estate retirement roadmap. Text the word radio to 88007. That's radio to 88007. Join now for $297, a 60% savings. Lifestyles Unlimited. Text radio to 88007.
Creating the lifestyle you've always wanted. You're hearing Lifestyles Unlimited's Real Estate Investor Radio Show.
Welcome back to the show. I'm your host, Andy Webb. If you have any questions for me, you can send those over to me at askandy@luinc.com. Again, askandy@luinc.com. And on today's show, we're talking about giving yourself a raise. Right, we just heard that the Census Bureau has reported that, hurrah, the median household income has finally increased after about a 5-year pause. From 2022 to 2023, it went up 4%, or about $3,200. Again, that's the median. That's the middle point. So you may have experienced something different, hopefully much, much better. But on the whole, that's the middle point. That's what we're going to be measuring against. We looked at cash flow in particular. And really, that's what's going to come to mind first when you think about giving yourself a raise. You go out and you buy one single-family rental house. And typically in the markets where we're investing, and I named a number of those, we're seeing cash flow, net cash flow, that's my profit every month, anywhere from $200 to $600 per month. Now, I just grabbed a couple of examples. One was right at $300, one was right about $450. If you annualize those, You get $3,600 and some change, $5,400 and some change. Both of those are beating that increase that we saw to median household income from one year to the next. So if you want to do better than the national median, it's very, very easy to do just through the cash flow. And we love the cash flow because that's what ultimately will retire you. It was not the things we're about to talk about necessarily that got me to my corporate retirement. By the way, at the age of 47, not 67, 20 years ahead of time. It was the cash flow that did that. So I was personally very focused on the cash flow and building that up in order to be able to retire. Same for my wife. Got her retired after about 3 years. If you're doing it right, you can retire in 5 years or less. You really can. You really can. But the beautiful thing here is it's not just the cash flow. Now, you go to your job, you've got earned income. It's not passive income. It's earned income. And you're making money one way by trading your time. You're trading your time. That's it. With our houses, we're actually making money 5 ways. We talked about cash flow. Big important way there. I want to see cash flow. I don't want to invest in a house on the coast that I am losing money on every month hoping that the value goes up. That's speculative. Don't do that. I want to see cash flow. That's what will get you to financial freedom and get you retired. But there's more to it. We have something called equity capture. And this is a very, very big component to our investments in both houses and apartments. So what is equity capture? Well, if I look at one of those houses, let me just grab here. This is the one north of Houston. I go out and I buy this house. It's $79,000. Wow. Did you know you can still buy houses for that price? You can. You can. You have to know where to look. After repair, price opinion or value, basically the market value once I've fixed it up, because it needs repairs. Okay, keep that in mind. Right at $187,000. Wow, I can buy it for $79,000 and it's worth $187,000. Now, in the middle of that gap there are repairs. And I took these, it doesn't have the repair budget on here. I just backed into the numbers. It's probably about $60,000 to $65,000, $60,000 to $65,000 to get this house fixed up. It's a 1980 build, about 1,200 square feet. Probably going in and doing all cosmetic. Right, it probably hasn't been touched since the 80s. They built decent houses in the 80s, had PVC plumbing, had good electrical. May not have to touch some of the more structurally related things, but certainly cosmetic, maybe a new roof, maybe foundation, since this is in Texas. But we're going to go in and do the work. Our cash out of pocket to buy this right at $16,000. But we're going to create, and that 16, by the way, sits in that property as equity. But on top of it, we're creating basically through the process by adding value another $36,000. That's our equity capture. And we're simply doing that because we're able to buy right, buy at a discount, go in, do the renovations, add the value back to that property, the value that's been languishing and been missing for decades, push up the value, and we capture that equity. And we'll get into a little bit more detail, I think, in the next segment. If I run out of time, we'll hit this in a later show. But we just heard one example there. $16,000 invested to create an additional $36,000. That's a more than a doubling. That's a tripling of my money right there. The other house that we had here from Houston, let's see, out of pocket invested $23,000, creating $38,000 in equity. Now that's not cash flow, and that's not an immediate raise. I think about equity capture maybe like somebody that gets paid, let's say, stock options. The company pays you a certain salary every year, and you get stock options on top. Do those stock options pay you every month? No, they don't. When do you get paid? You get paid when you exercise your options, right? When you convert them into actual stock. And then when you sell that stock or start to cash in the dividends, whatever's going on there. Same applies with our houses. We get the equity capture. It's an unrealized gain until I go out and exercise my options. And we have a lot of options when we invest in real estate. I can go and sell that house and pull all of that equity out that we've captured. I can go and do a cash out refinance and pull not all, but a good portion of that equity out. Maybe I just want to sit on it for a little bit longer, collect those rents and do nothing. You can do that too. But as you watch that equity build, you're going to want to take some level of action because your return on equity goes down over time. Now, that's equity capture. So we've got cash flow, we've got equity capture, but you can continue to give yourself a raise by hanging on to that property for a little bit longer because we experience 2 more things that drive equity. One of those is called equity buildup. I mentioned this is a rental house. We've rented to some residents, great family, whatever. They're paying the rent every month. And from that rent, what am I paying? I'm paying the mortgage. And every month, my principal goes down. And it goes down again, and it goes down again, and my equity builds up. We call that equity buildup. Now, that's not a huge number. Depending on your debt load on that property and your interest rate, you might be amortizing anywhere from $150 to maybe $250 per month. But if I do the math, again, looking at these houses that we're exploring, that could be about $1,800 to maybe $2,000 per year. little more. In my experience, that's anywhere from about an 8 to a 12% return, just right there. And I'm not doing anything. My residents are paying the mortgage for me. It's a great thing. And aside from equity buildup, the other way that we do see our equity increase is because we're holding an asset. And in Texas, on average, over the years, if you measure across a longer timeline, we tend to see about 5%, 3 to 5% appreciation in property values. Now, that appreciation spiked massively after the Great Recession. It's leveled off here in Texas a bit. But let's just say, for the sake of argument, let's just run with 4%, right? We saw that the median household income went up 4% from 2022 to 2023. If I take this house that I've been looking at where the after repair value is $187,000, I fixed it up, it's rented out. Let's just say I hold it for 3 years. I'm going to watch that thing appreciate. Let's just use 4%. At 4% every year, that goes up $7,500 in year one, $7,800 in year two, $8,000 in year three. And over my 3-year hold period, I'm going to see somewhere north of $20,000 in equity added. Now, we've got this equity that we've built and is building as we hold. At some point, you have to make a decision, or that syndicator makes the decision on your behalf if it's apartments and you're invested passively. But we've got to get that equity out. We can sell, as we talked about, get all of it out, net of our transaction costs. We can do a cash out refinance on a house, typically 75%, and pull out a good portion of that equity, or we can keep holding. But let's say we're going to tap into that equity. Now we've got a big capital event. Now, I don't view this as cash flow in the sense that I've given myself a raise to the tune of, what did we just say on that? Well, let's add it up. That one house that we've been looking at, cash flow $3,600 per year and some change. Forget about the cash flow. Let's just look at the equity side. Through market appreciation, just by holding for 3 years, I've come in at around $23K. My equity buildup, I'm just making an assumption of, well, what did I assume here? Looks like $150 per month. That actually goes up every month, but it's about $1,800 per year. So my equity buildup over 3 years is north of $5K, $5,400. And then we have our equity capture that we talked about, over $35,000. If I add all of those together, my net equity play here is $64K. So I cash out. Let's say I sell. Now, there are tax implications if I sell. I may have to pay capital gains taxes, or I can do a 1031 and roll that into my next investments. However you choose to do that, you're pulling that equity out. It's a big capital event. Now, you can do a number of things. You can go to the beach and play. I don't recommend that. Maybe reward yourself. Maybe have a little bit of a fun time, but reinvest that. Put that into more houses so you can double, triple, quadruple that cash flow. Reinvest that in more apartment opportunities so you can build that cash flow. And this is how you get more and more cash flow every year, just like Dell has done, just like I have done, by reinvesting. So with your job, you wait, you hope for that merit increase, 3.5% on average, 4% if we're looking at this recent report. If you lose that job, by the way, what happens to that income? Gone. Hopefully you've got somebody else in the household bringing it in, or maybe a second job, I suppose. With our houses, although it may seem daunting if you're listening to me for the first time, never bought a rental house, we don't normally buy just one. In fact, you buy one and you figure out how easy it is to manage the purchase process, the rehab, the renovations, the lease up, the ongoing management. So you buy another. So that one house we saw $5,400 per year, other one we saw $3,600 per year. Bam, I'm bringing in $9,000 every year. So then I go and I add another one after that. I'm at $18,000, right? You continue to add. Now, let's say one of those goes vacant. I'm equating this to losing your job. Guess what? You've got that other rest of your portfolio kicking off cash flow. You go and release it, maybe at a higher rate, and now that cash flow resumes. You stay cash flow positive, and then you add more houses, and it just continues to grow, to aggregate. Apartments, same thing. Apartments, even better, inherently have multiple units. You invest passively in a 200-unit apartment. One of those goes vacant. Not a big deal. So how are we doing it at Lifestyles Unlimited? We do have a very specific model. I've said equity capture, I've said renovations several times. What we're doing is we're going out and finding houses and apartments that are distressed, that need some sort of repositioning. So we get those at a discount. That's what helps us create that equity capture in the first place. But we typically have to go in and do renovations. Again, on the example house I saw north of Houston, I don't have the scope of work here, but based on the budget I've backed into, about $60K, that's going to be cosmetic. It's Texas, so there's probably a little bit of foundation work. There's probably something going on with the roof. Maybe it needs a new AC. Right? I can get all that done for $60K. So what we do is we go out and we renovate both the houses and the apartments, and we follow the motto, best product, best price. We do that because we want to put the best product on the market that helps us rent faster and achieve a better rent, right? That equates to higher cash flow. And over the hold period, a lot of people get worried. They think tenants taxes, toilets, right? The maintenance bear. Ooh, that maintenance bear is going to rear its head. It's going to make my life miserable. My cash flow is going to go to zero. But when you follow this model and you go in and fix everything up now during the renovation period, anything that's broken now or could break in the next handful of years, get that AC inspected. How old is it? Is it still Freon? Right? Get that roof inspected. Does it need repair, or should it hold for another 10 years? Or do I need to take a replacement on now? And when you fix everything up front, your maintenance goes to zero, so that when you collect those gross rents and you pay those fixed expenses, which are your mortgage, your taxes, and your insurance, you have no maintenance, you keep the balance. That happens when you follow our motto, best product, best price. Plenty of people don't. And I hear the nightmares from the people that don't. Fix these things up front. Make it part of your CapEx. So that's how we're doing it. But then you think about it. You listen to the show for a while and you're like, yeah, I'd like to do it. But, and there comes the big but. Common hurdles to you being able to go out and create a raise this year and do it again next year and do it again the year after that. You say to yourself, I don't have the time because I'm working a job, Andy, earned income. I have to do this thing to support my family, to provide for my family. Yes, you do. So I don't have time. I don't have the money because of said family and daycare costs. And yes, inflation has been up. We've not seen an increase in our standard of living, as that article said. I don't have the money to spare, and I don't know how. Big common issue. I don't know how. I don't know how to find the house. I don't know how to renovate it. You shouldn't be renovating it, by the way, by yourself. So we leverage a number of things. We leverage other people's time. So I mentioned throughout the course of the show these couple of houses. I did not go out and find these houses. I did not go out and scour the MLS. I did not go out and network with all the wholesalers in and around Houston. I'm in Dallas. It's a little bit far for me. I have somebody that's doing that on my behalf. So you build team and you use other people's time. Realtors to find the properties. General contractors to renovate those properties. Somebody to manage it if you have to. Everybody you need to help you through the process. You use their time so that you can continue to work, because you do want to continue to work to pull in that income, because we need that W-2 to follow the lifestyles model, to use the financing that we do. But use other people's time, because you don't have the time. I didn't have the time when I began either. But I still bought 5 houses in 2014 that added massively to my cash flow. Gave myself a great raise in the same year that my company chose not to. But I don't have the money. You'd be surprised, and we talk about this, places to go to find capital. Borrow from your 401k. Mike Harrison, another host, he's done that. I cashed mine out. So there are ways to get to that. And you'd be surprised when you go out and use financing on these properties. I just gave you an example here, $16,000 out of pocket to buy a rental house. That's it. Can you find that? To go out and create an additional $3,600. That's a 22% return, by the way. Yeah, okay, I can find the money, but I don't know how. You know what? We teach you how. That's what we do at Lifestyles Unlimited. In fact, we've got what we call our 2-day financial freedom seminar going on in places like Dallas and Houston, in San Antonio, over in Virginia, Colorado Springs, coming up there, Chattanooga, lots of places to go. San Antonio is going to be our next one. That's going to be September 21st through the 22nd. If you're in the area, you can go in person. If you're not, you can attend via live stream. But you can learn more if you text the code RADIO to 88007. Go check it out. Learn about the 2-day financial freedom seminar, where we teach you everything you need to know how to do these things. And get out and get started. Give yourself a raise.
The information and opinions you hear on the Lifestyles Unlimited Real Estate Investor Radio Show are those of the hosts, guests, and callers. The Lifestyles Unlimited Real Estate Investor Radio Show is for entertainment purposes only. Please consult a professional regarding your personal investment needs. Nothing presented constitutes an endorsement, recommendation, offer, or solicitation to buy or sell any product or security.